Welcome back to Resolute Reveal. Today we're diving into one of the most important topics in commercial real estate right now, and that is debt, capital markets, and how deals are actually getting financed in today's environment. And we have a really special guest today to help us unpack all of that. He is someone who lives and breathes in this world of financing every single day. Kurt Dennis is joining us from the Marcus and Millichap Capital Corporation. He's a seasoned capital markets advisor who works in all asset classes, helping owners and investors sort the right debt, structure the deals, and navigate in an environment that's been anything but predictable in the past few years. So he's got a real front row seat to what is happening in the markets, seeing lender sentiment, interest rate shifts, et cetera. And so we're really excited to have the conversation today. So Kurt, welcome to the show.
Welcome,
Yeah.
Kurt.
Thanks for having me, guys. Appreciate it.
Great. Well, a lot going on. Things have been changing over the past few years. So I think, sentiment has been changing since. But why don't we start with what you're seeing in the state of the capital markets today? Your activity and conversations with lenders, maybe the deals that you're seeing, anything that you want to talk about to help us out.
Yeah, no, just give you a little bit of background on myself. I'm a managing director at Marcus Millichap Capital Corp. Been in commercial real estate for 25 years now. Done everything from lending to asset management, underwriting, acquisitions, dispositions. So I think wearing all those hats over the years gives me a unique perspective to be able to advise my clients, no matter what point in the cycle we're at. But what we're seeing, I guess in general, it seems that we've turned the corner a bit, and seeing lending activity has picked up this past year over the year prior. And, acquisitions activity is starting to pick up a little bit. And, refinancing is, very heavy, but, there's a lot of challenge deals out there. So it is making it more difficult to refinance a lot of these transactions. So we're having to get more creative there to get things done. Seeing plenty of debt capital out there from lenders. So plenty of lender appetite out there.
When we talk about lenders, I think what might be helpful is if you'd be able to break down all the different capital sources that are out there. Because if you're just talking to your mom and pop investor, it's just for them, they go to their local bank. But there's a lot of different options out there, right?
No doubt about it.
Can you break that down for someone to really understand?
Yeah, so what we do here at Marcus Millichap Cap Corp is we make a market for our clients' financing. We sit down with our clients, we look at their deal, what their objectives are, what their business plan entails, what their time horizon, hold period looks like. And that, we use that as a guide to navigate our clients to the best loan product for their particular situation. And so that could be a local or regional bank deal. It could be a credit union deal, federal credit union deal. It could be, if it's a multifamily deal, it could be Fannie Mae, Freddie Mac, which we provide Fannie, Freddie, and HUD loan products as an extension of our JV partner, which is M&T Realty Capital. So we offer all those products at no additional fee to our clients. If a client is looking at a heavy value add play, where there's an underperforming asset, maybe low occupancy, and a lot of CapEx needs, and a client wants to get in, add the value, and then get out, it might be a great fit for a bridge loan. So there's a lot of private capital out there that can provide these bridge loans at higher leverage than a lot of the banks and credit unions can for those type deals. We also place clients with life companies, for permanent debt. Generally, there's another loan product that's been around for years, and that's called CMBS, or commercial mortgage-backed securities loans. And those are permanent 5 or 10-year, permanent loans, non-recourse. So that's another loan product that could be a good fit, good solution.
Has that class increased again in volume?
It has. Absolutely. In fact, 2025 is the highest loan volume in the CMBS market since before the great financial crisis. We haven't seen the same level of CMBS since probably 2007. So it's still way down from where it was at its peak before, the financial crash of 0809, but it's come way back. And it's
probably never will return to those levels.
No, I don't think it will, but it serves a purpose and, fills a niche out there in the market.
But what is that niche? What are you taking to CMBS?
Yeah, it's right now CMBS is offering full-term interest only, and as a result, in their underwriting to typically a 125 or maybe a 130 debt cover on interest only. And so we're getting higher leverage out of that loan product than some of the other loan programs out there. And it's non-recourse. So if somebody wants max leverage and they have to have non-recourse, maybe it's a deal that's not a fit for maybe Fannie Mae or Freddie Mac in the multifamily side, maybe it doesn't quite have the minimum occupancy that the agencies require. And CMBS could be a good option in those scenarios.
And is there a deal size or asset class that typically goes CMBS? Is that a major decision point as to whether or not it would go that route?
That's right. That's a good question. Typically, CMBS is designed for larger balance loans, typically at least 5 million and up. So, yeah.
Kind of circling on that. So we did touch a little bit on what's happening today. Can you maybe dig into a little more of the differences that are, from since the 2023 slowdown up until now, the things that have been changing, and then also, how would you be describing the lender sentiment, moving into the end of the year and looking into 2026?
So, lender sentiment, I think is up. There's plenty of debt capital out there. In fact, the agencies, both Fannie Mae and Freddie Mac, they just increased their caps for 2026. They increased the caps from 73 billion each to, I believe, 88 billion for 2026, so about 15 billion increase. So they're anticipating big volumes next year and an increase in loan volumes. And so they're looking forward to providing, plenty of liquidity in the market to finance multifamily. As we just talked, CMBS volumes are up, and don't see that slowing down next year. I see that increasing. So, I think lenders are generally bullish about placing more debt capital next year. And so I think we're going to continue to see an uptick. And, as far as changes since 2023, when the rates shot up and, the bubble burst a bit, I think we've seen lenders become more conservative and, a lot more scrutiny in their underwriting. Loan officers, credit committees, credit officers, we're getting a lot more questions on deals, a lot more questions of borrowers. They're digging deeper, into, borrowers' schedules of real estate, asking more questions there, and they want to see, they're really digging into any underperforming assets on borrowers' existing schedules of real estate. Maybe a borrower shows some properties that have low occupancy, maybe lower than 90%, or debt service coverage ratios below 125, which is typical lender minimum. And they're going to ask questions on it. They're going to dig in and want to understand what's the story there. They're being more cautious and making sure that they're not stepping into a situation where somebody's looking to get a loan to try to right size some problem assets elsewhere.
Yeah.
We are seeing some lenders pass on deals if that's the case. So somebody, maybe somebody has a KP or key principal on a deal that maybe has some issues in their balance sheet. Having some tough conversations with some clients saying, looks like you may need to find another partner for this deal because, maybe a KP has got some issues in their portfolio they were unaware of, and they may need a stronger partner to get a loan done.
I anticipated more pain in the market than we've actually seen. I mean, I know it's been out there, but in terms of refinances, it seems like one way or another, people are making it work in this climate where interest rates have shot up. And I just expected that to be a bigger problem than it has been, which means there's a lot of creative ways that people are making it work in this climate. Can you speak to that at all? And or maybe I'm just wrong and there's a lot of pain that I'm not seeing, but you're on the front lines.
Yeah, I think it depends on, the which sector you're talking about. There is a lot of pain in the office sector, and there's quite a lot of pain in multifamily as well, particularly
We're primarily retail, so maybe that's part of the reason
yeah,
I'm
I
not
think,
seeing it.
in the retail sector, that's been the hottest sector out there. It's been the steady performer. There was a time when retail was kind of lagging multifamily and industrial, and that shifted. Retail is now the best performing asset class out there. And it's I liken it to, cap rates never compressed to super low levels
Hmm.
prior to interest rates shooting up. And so they've had more room to absorb the rise in rates the last few years. And so we're seeing retail deals continue to underwrite better and having much more viable financing and refinancing options than the other asset types.
I guess the rising rents have also helped absorb the rising interest rates as well, and so it hasn't thrown things quite as out of whack as
For
you'd
sure.
expect. Yeah.
No doubt about it.
So how have you been making the deals work in the other sectors where the DSCR is out of whack? And I mean, are you making those deals work?
We are seeing a lot of deals where there's loan modifications and extensions. So a lot of lenders kicking the can down the road, 6 months or a year at a time. So a lot of those deals that we thought would be foreclosed by now have not, has not come to fruition. So that's kind of, delayed some of the price resetting that, frankly, probably needs to continue to happen in the market to an extent.
Hmm.
But, asset prices are already down across the board in most sectors, retail probably being somewhat of an exception. But, we're seeing other creative financing. We're getting deals done, like for some of the construction deals where maybe a development was delayed, due to COVID and lease up was slower than the developer thought. And, still not quite to stabilized occupancy. We've been able to come in and place bridge financing for those deals to get folks out of their maturing construction loans. So, we're also seeing mezzanine and preferred equity in particular, helping to fill the void. And got a lot of clients that have been asking about that to help fill that void in the capital stack where, a new senior loan may be coming in a little lighter than needed to get them out of their current debt.
Is there a lot of extend and pretend right now? You mentioned that a lot of lenders are extending. Do you is that back as a thing?
It's, I would say a year or two ago, we were seeing a lot more of that and a lot more willingness on the part of lenders to continue to try to, extend and pretend. I would say the tide started to shift this year and seeing lenders be a little more rigid and, just kind of being, with deal fatigue, saying they need to be paid off or refinanced and much more rigid in their requirements. I think, now and I expect that in the next year as well.
Let's talk about where interest rates are. We've had the Feds in the news. I mean, we've got another announcement next week. What is that meaning for deals, and what is the relation to commercial real estate lending?
Yeah. So next week, the Fed's meeting again, and the market is anticipating a 25 basis point rate cut. So the Fed started cutting rates back in 2024, and they've lowered rates about 125 basis points so far. So everybody, borrowers, our clients, a lot of people think, hey, the Fed's about to cut rates, so mortgage rates are about to go down. It doesn't exactly work that way. So there's the short end of the yield curve, and then there's the long end. So when the Fed cuts their overnight rate, that does have a direct impact on construction loans and floating rate bridge debt. Those are tied to the overnight, closely tied to the overnight Fed funds rate. So that is pretty much a one-to-one impact on short-term floating rate debt. However, for permanent mortgage rates, 5 and 10-year money that most of our clients are looking for when they're buying a, existing asset, maybe, and looking for kind of mid to long-term debt on those deals. Those deals are tied to the treasury indices. So typically the 5 or the 10-year treasury index. Those indices move independent of whatever the Fed does. I mean, they're influenced to an extent, but it's not a direct one-to-one impact when the Fed lowers or raises rates. In fact, last 3 times the Fed has cut rates, the treasury markets have actually increased a little bit. So a lot of folks have been sitting on the sidelines saying, I'm going to wait about refinancing or I'm going to wait about buying until the Fed cuts rates. And they were wrong because rates actually went the other way slightly. Now, all in all, I would say longer term rates have settled in over the last year. So they are down overall from where they were about a year ago. So
That was my question: is how much have they moved downward over that same period of time that the Fed has been cutting rates?
So kind of looking back, I'm going to step all the way back to, before the great financial crisis in 08, 09. So if we go way back then, from the time period 2000 to 2008, in rates were in the 6% range. And when the financial crisis hit 08, 09, the Fed artificially dropped rates to nothing. And they left them there for well over a decade. So they really left them too low, too long, something artificially low. And so that's what everybody got used to. So 2010 to 2019, median rates for commercial mortgages were generally in the 4% range. And so that's where everybody got fat, dumb, and happy with those low rates. And then when COVID hit and inflation, all the government stimulus hit the system and the market was flush with cash and liquidity, inflation took off and the Fed jacked up rates to cool the economy. And so after they did that, rates shot up to the 6 to 8% range, generally, for most deals. And so now we're back into, generally the 5s to 6% for most, 5 and 10-year money. And so we're back down to about where rates were before the financial crisis started, back in the early 2000s. So this is a pretty normal interest rate environment we're in right now. These are pretty good rates. Nobody wants to hear that because everybody was used to the 3 and 4% money, that was available just a few years ago when, after COVID hit and the Fed did slash rates to nothing temporarily. But, that's generally what we're seeing out there is kind of 5s to 6s for most deals.
And Kurt, where exactly are they going to be at this time next year?
So right now, I mean, there's no data to point to longer term rates coming down any. I mean, if you look at the forward rate curve, it actually shows rates gradually rising from here. So, if somebody's, trying to make a decision, should they pull the trigger on a new deal right now or wait for rates to come down? It really depends on, are we talking about a floating rate deal, auction deal, bridge deal? Those rates, we do expect those to continue to come down a little bit more. So we think the Fed's going to cut rates, over an 80% probability they're going to lower the short-term rates next week, another 25 bips. After that, next year, there's less certainty. There is going to be a new Fed chair. I think he's going to start in May, I believe, May timeframe. And so there will be a lot of pressure from the president and the administration for that new Fed chair to, wield as much power as possible to reduce rates. But, it remains to be seen how much further short-term rates are going to come down. But if somebody is talking about a longer-term deal and they're looking for 5 or 10-year fixed rate money, there's no reason to believe those rates are going to come down any based on forward rate curves that are out there. My personal opinion is, if we see enough rate cuts by the Fed next year, I honestly think that could drag long-term rates down a little. But I don't think it's going to make much more than about a 25 basis point or so change to long-term rates. Because I think we're at a pretty healthy rate range now, longer term, but it remains to be seen what tools the Fed may use to reduce longer term rates. They could implement quantitative easing a little bit again, where they buy back Treasury bonds and artificially lower long term rates. That's a possibility. I see that as one of the only real options they have to reduce long term rates, and they really don't want to do that. As far as buying back bonds, they've been trying to get the bonds off their balance sheet that they bought, after the financial crisis.
So let's step into, if we have a buyer today, and maybe we could focus this on, because, I know you cover a lot of asset classes, but since we're in retail, we have a buyer, say, hypothetically, wants to get into a shopping center that we're selling. Can you go through, what it actually takes for someone to get a loan approved today? What would they have to be concerned about? What are they looking at? What would they have to prepare, and expectations, if you could?
So, and the first thing, I advise clients is, lenders are looking for, they want to see what's a borrower's net worth and liquidity in comparison to the loan we're talking about. So they generally want to qualify for financing with most lenders, they need to have a net worth at least 1 times the loan amount we're talking about. So if we're talking about $1 million loan, they need to have at least $1 million net worth.
Okay.
And post-closing liquidity is also key. So lenders want to make sure somebody's not putting all their life savings and everything they have into a deal and they have nothing left over in the tank. So they want to make sure that a borrower's got plenty of reserves left over in case things don't go as planned. And that typically is at least 10% of the loan amount post-closing for liquidity. And when I'm talking liquidity, that's cash and marketable securities outside of any retirement account, that somebody can tap into, on a rainy day if occupancy falls or rents fall, they lose a tenant or whatever. Another key thing for, qualifying for a deal is, lenders really want to see, does the borrower have any track record in a retail asset or whatever the asset type is? Is this their first rodeo or have they done this before? So that really helps. And if it's their first deal, we might see lenders get a little more conservative on terms. They may not offer max leverage for somebody doing it the first time.
Yep.
And can you speak to that leverage a little bit and LTVs that you're seeing in the different asset classes?
Yeah, so generally, I would say most deals we're seeing LTVs in the 60 to 70% range. Starting to see some, I would say in retail in particular, some deals can size up to 75%. Just depends on what the cap rate is that a buyer is able to negotiate, and if there's enough positive leverage there, so that we have plenty of, you know, debt service cushion. Everything is, I mean, the reason the LTVs have been lower is because everything is debt service constrained, and lenders still need at least a 125 debt cover for some deals. Maybe as I mentioned, maybe if a borrower doesn't have much experience or maybe it's a smaller market, we're seeing some lenders that they may require a higher debt service coverage, maybe a 1.3, just to give them a little more cushion and comfort of safety as a lender. And so that's impacting, resulting in lower LTVs.
Yeah.
Got it. And how about recourse and non-recourse trends for, say, a shopping center or multifamily or, different asset classes right now?
Sure. As far as non-recourse, it is available. We talked about CMBS as a loan product, and those are non-recourse loans. For larger deal sizes. Most of the life companies, I would say for, particularly in larger balance deals, those can be non-recourse. For the banks, to get non-recourse, I would say generally has to be a very strong borrower and typically a little bit lower leverage. And at that point, and by lower leverage, I would generally say less than 60%, could even be less than 55% LTV, for banks to entertain non-recourse. We have seen, I would say, some of the smaller balanced life companies that we've closed a lot of business with used to routinely be partial recourse. Maybe the top 25% of the loan only would be recourse, non-recourse below that. But we've seen some of those lenders kind of pull back and require full recourse from the get-go the last couple of years or so.
And
Understood.
Kurt, where do credit unions enter the picture, and when are you going to credit unions with deals?
So, they're a good option. We've placed several deals over the last few years with some of these federal credit unions as well as local credit unions. And we've seen the credit unions offer more attractive pricing than a lot of the local and community banks in particular. So, if it's a, more localized deal, maybe not a fit for some of the larger loan programs, these credit unions can be a good fit, and they can do some things, that a lot of the banks can't. We tend to see them a little more conservative on leverage at times than some of the banks, but their rates can be much more attractive. And they can often, do longer amortization, maybe 30-year amortization on some deals, whereas a lot of the banks are more rigid and they won't go above, say, 20 or 25-year amortization.
Got it. How about let's touch a little bit on creative financing and how deals are getting done that way. Mezzanine debt, preferred equity, if you want to give us some insight into that, and loan assumptions particularly too. Can you give us some insight on what you're seeing on those, and maybe give some clarity for investors on those types of options?
Yeah, so typically loan assumptions are a possibility with some of the permanent loan products out there, particularly with the agencies and CMBS. So Fannie Mae, Freddie Mac, CMBS loans typically allow assumptions. Some of the life companies as well, probably not all, but I would say most are assumable. And so it can offer, I mean, in today's environment where rates have gone up considerably from where they were a few years back, that can be a great option. And we've seen a lot of deals get done by new buyers coming in, stepping in and assuming the existing debt at below market rates. You asked about preferred equity and mezzanine debt. So we've gotten numerous requests, I would say, over the last couple of years or so from folks looking to stretch loan dollars. Senior loans are coming in at lower LTVs in today's environment because of higher rates. Preferred equity and mezzanine debt is out there, and we've seen, you know, that sector, pick up to kind of fill the void and maybe take a loan from say 65% LTV up to maybe 70, maybe 75% or so in this market.
Have you seen, has there been a specific uptick in that type of loan choice over the past few years? And do you see that declining, or like, do you see that?
We get a lot of inquiries about it.
Mm-hmm.
However, the caveat is, preferred equity and mezz comes with a higher rate. So a lot of borrowers, when you're talking those kind of rates, their eyes tend to glaze over because they're like, well, I don't want to pay that. So they have a choice, to be made between just raising common equity to fill that gap and just raise more equity from their investor pool, or utilize, a preferred equity provider or a mezzanine provider that, is likely going to charge low double digit type rates for that money. Because
And there's still a ton of that equity out there.
there's a lot of preferred equity and a lot of mezz money out there looking to get placed in this environment. But equity, I would say, generally has been a little more constrained last few years, with, I would say, more common equity investors on the sidelines, just kind of waiting it out, waiting to see what happens.
Mm.
I've heard that office is making a little bit of a resurgence. Is that something you're seeing?
It is. 2 to 3 years ago, a lot of lenders, frankly, were on the sidelines with office lending. And so that tide has turned. And CMBS in particular was having a conversation with one of our active CMBS lenders in the last week or two. And CMBS loan pools are now back up to around 20% or so of these pools are now office loans again. And just a few years back, it was probably 10 to 15% or much less in most of the CMBS pools. So CMBS lenders are back looking at office selectively. They're being very careful about the asset and the borrower's track record. And, is the asset in line with, the submarket occupancy? If it generally is, and if the basis makes sense and there's plenty of cushion for debt coverage, then we're seeing, some lenders dipping their toe back in the water into office lending again.
And what about construction financing? I mean, have you seen a big change in the amount of construction financing?
So, construction pipeline, I mean, that spigot was kind of shut off because so many deals just didn't pencil. And so it flowed considerably. A lot of lenders were not getting the construction loan payoffs timely as they thought they would. So a lot of deals got drug out, due to COVID. Maybe they were delayed by COVID and slower lease ups than they thought. So we have seen a lot of lenders where their construction buckets, were constrained. I would say 2 to 3 years ago. I would say this year it started to turn a little bit, and we are seeing more interest, getting more lender quotes from banks, looking at construction deals again. Yeah, that's based on, my direct experience placing some construction loans this year. Just I was pleased with the amount of response and the level of quotes that we got in the door for our clients. Because 2 years ago, it probably wouldn't have been the case.
Which asset classes are those that you're seeing pick up?
I would say multifamily, self-storage, retail, I mean, all the asset classes. I would say, office, no. I mean, hardly anybody's building new office right now, unless maybe it's a build to suit or something like that. Generally speaking, the other asset classes, industrial, particularly if there's pre-leasing, that's going to be key to get any commercial construction loan done is, the amount of pre-leasing that's been done by the borrower.
Sure. What do you see for this next year for your pipeline? I mean, do you anticipate it being a bigger year than 2025?
I do, for sure. I feel like the tide is turned. The winds are starting to blow in a favorable direction. Rates are down from where they were. We've seen property insurance rates come in, and so that's helping as well. So I think with rates having come down, settled in, at least they seem to be settled in and kind of dialed in where people sort of know what to expect from, for long-term rates, and shorter-term construction and bridge rates are down and coming down further. So I think it's a good time. And I think, asset pricing, I think the bid-ask gap is come in some. And I think that's going to continue to come in a little bit more next year as people, are faced with loan maturities and they have to make a decision and are willing to go ahead and move on from some of these assets.
Yeah. Touching on that, I mean, a lot of our clients have had that can kick down the road over the past, 24 months. Likely not going to be kicked any further. So any advice on some of these owners, looking at those maturities in the next 12 to 24 months?
Yeah, I think a lot of lenders' patience is worn out or just about worn out. So, some folks that were counting on a lender working with them, that didn't end up being the case, didn't end up holding true.
Hmm.
So I would not count on that. So
Yeah.
I would look to, make a move, and, whether that's doing a cash in refinance on a deal or whether it's selling it and recouping as much, of your equity as you can and moving on to live another day and go redeploy that capital in today's, better priced environment.
So, I guess, before we go, is there anything that brokers, other investors and owners should keep in mind looking into 2026? Just did touch on maturities, but, for active investors out there, anything to keep in mind?
I think, real estate, I mean, it's cyclical. I think we all know that. And, we've been in a downturn the last few years. And, we've turned the corner now. So I think next year and the year following, should be the start of another upcycle in commercial real estate for hopefully many more years to come. And, I think with a lot of the asset types out there with the construction pipeline, pretty much down to a trickle, not where it used to be. That should bode well for operations at properties. So that should bode well for occupancies and rent increases and enhancing value for commercial real estate assets. So, as we sit here today, I think things are looking up. So I think next year and the years coming ahead are going to be good.
So, Kurt, for owners or brokers who want to reach out to you, can you provide your information and tell them how to reach you?
Sure. I'm at the Marcus and Millichap office down in Houston, Texas. Phone number is 713-239-0509. Feel free to give me a shout anytime. Happy to take a look at a deal you're considering and give you our quick feedback on different financing options out there.
Fantastic. Yeah. Well, Kurt, thank you so much for joining us today. It was really, really insightful. I appreciate you taking the time and making things a lot more clearer for many of us in particular. Again, we'll have Kurt's contact information in the description of the podcast. And he's a great guy to work with, super helpful. So brokers and investors out there, feel free to reach out to him. So Kurt, thanks again. Thanks for all the clarity. And we hope to have you again soon.
You bet. Thanks, guys. Good to be with
Okay.
you.
Thank you.
Thank you, Kurt.
Take care.
See you.